Katrina, do we see 4 hikes?
I think it's really going to depend on what happens with Omicron and whether or not we get another variant. We are looking at a situation where the Fed is obviously very, very far behind the inflation curve in terms of its rate hikes. So I think we came into this year, consensus was 3 hikes. It's now trending towards 4. That's on the more hawkish tone. The dovish side will be if Omicron and then another variant continues to derail the economy. In particular, it's derailing the return of workers because obviously those quarantine requirements mean they can't go into the office and, more importantly, go back into the factories.
If that turns out to be the case, how does the market react? Is Omicron going to be a growth drag and therefore that's negative anyway for stocks? If it's not a growth drag and it's not if it actually potentially pushes up inflation, that's going to mean the Fed is really in a quandary, potentially has to act even faster further down the road. None of that sounds like a particularly good outcome.
I think we're in such a different environment for the first time in such a long period of time. We're looking at a Fed that needs to hike rates at a point in time where our debt levels are a very high percentage of GDP, over that 100%. So we're just not used to being in this situation. Previously when we've looked at rate hikes, we've seen the Fed hikes rates. Obviously, you have that impact in terms of it flows through the budget. We tighten some of our federal budget mechanisms, and that's like the alleviated to inflation. But I'm not necessarily sure we're going to get that kind of flow through this time, given the high level of debt to GDP, but also just given the mood in Washington and their willingness to just keep spending and spending and spending. And a lot of that spending is inflationary. We've talked a lot about supply side inflation, and that's what we've seen previously. We're now starting to see the services inflation, and coming on the heels of that services inflation, which is very much wage driven, is going to be the inflation that's driven by owner-occupied rents. We haven't talked about the rise in home prices, so they were up 20% last year, and that's got to flow through the owner-occupied rent. So I think we actually are going to see inflation for longer here. I don't necessarily think it stays at the very, very high levels, but I don't see anything under 2% for a long period of time.
Where do you hide out in that scenario, Katrina?
I think obviously, there's some places where the adjustment's already taken place. Have a look at, the NASDAQ is, for example, it's not just this year where we've had a lot of carnage. You've had 4 out of 10 stocks in the NASDAQ down over 50% from their 52 weeks high. But the areas we like are areas where you are seeing things like chemicals. They're cyclical companies. We think that they've got a very good tailwind. Obviously, we've been talking about Fed spending, but there's still a lot of spending to come in 2022, and we think that that'll drive higher earnings. So a name for us is Covestro. As a specialty chemical company, it's something that we think has got a really good earnings momentum combined with a low valuation, and I think that that's what you need to look for in this type of market.
In this type of market, at what point do you start thinking about buying bonds, Katrina? They haven't been a buy for quite some time. A lot of people have been nervous about owning them. If we get to 2% on a US 10-year, is that a buy? If we get to 3%, is that a buy? There's a lot of discussion about the pace of rate hikes here, but there seems to be a lot of confusion still about where the terminal rate is. How far does the Fed go?
I think that how far the Fed goes is actually going to be much slower than they anticipate because of this tension that we have given our high levels of government debt. At the moment, if you're buying some of these notes, you're actually getting negative real yield. So basically, you're not even covering your rising costs. That's a very different setup in the equity markets where obviously you have that degree of inflation and protection. So I am somewhat cautious about entering into the bond market and particularly entering into the longer end of the bond market until we see something of rates, up in the 2, 3, even 4% range, which is a step up from where we are.
Yeah, Katrina, you're still looking at negative 73 basis points for the 10-year real yield, to your exact point. So opposite question, at what point do you buy technology?
Look, I think there are pockets of technology where you've had competitive threats, and those competitive threats combined with the valuation risks that we've seen from the rising rate or the expectation of rising rates has caused these stocks to sell off. So, for example, we like the payment space. It's an area where people have got very concerned about competition. We've done our homework. We're stock pickers. We like to do that. And we think that there's a real opportunity there. In terms of going into the profitless tech, I'm a value investor, so I like to see real earnings. I like to see real cash flows. And so I'm not going to play in that space for some time.